Did you know that you have a business partner in your pre-tax 401k and that they actually own a substantial amount of your future income? I'm James Studinger, author of Wealth is a Choice and financial planner. I do believe that wealth is a choice and that we get wealthier by buying things that make us more money. If you've saved into a pre-tax retirement plan, then when you look at your statement and you see that number for what it's worth, that's not all of your money. You have a business partner, and that is the federal government. They made you an offer. Put your money into the retirement plan pre-tax and take a tax break today. But in doing so, they are entitled to a portion of all of your income for the rest of your life. America took them up on their offer, but I wish that I hadn't. To be fair, we didn't have a lot of choices back when we got started saving into our retirement plan in our career, but now we do, in the Roth component of your workplace retirement plan. See, back when I started my career in the 1990s, there were really two options to save for retirement: your pre-tax workplace retirement plan and an IRA. I maxed out the 401k, which at that time was around $15,000 a year, and thankfully I was smart enough to also max out my Roth contribution, which was $2,000 a year. Today, 2023, the 401k max is $30,000 and the Roth IRA is $7,500. If you're under the age of 50, it's $22,500 and $6,500. All of those savings can go into a Roth. But what do we do with the legacy retirement plan money that we saved into pre-tax? Well, many savvy investors will buy out their business partner. You can convert your pre-tax retirement plan money, or a portion of it, into a Roth IRA. But in doing so, you have to report the amount you convert as taxable income. For example, you might convert $100,000 from a pre-tax retirement plan into a Roth IRA, and you'll have to report $100,000 of income in that taxable year. Even if you only paid $25,000 into the account that's now worth $100,000, they get to keep a portion of that. That was their deal. You can buy them out now, or you can buy them out later when you spend the money. One way or the other, they're going to get their money. There's no way around it, unless you die. But even then, whoever inherits your money will pay taxes on it, unless it's given to a charity, but that's another discussion in another video. In any business transaction, you look at the numbers and you see if it's worthwhile. As far as a Roth conversion, at least in 2023, I think it's a no-brainer. The government price tag is determined by your tax bracket. Years ago, when you saved the money in the retirement plan, you were probably at a higher tax bracket than you are today. So it's possible that you could convert money into the Roth at a lower tax bracket. In fact, tax brackets and tax rates are lower than they've been in the last 100 years. So it's likely that the government's offer to buy them out is never going to get better than it is today. If you watch my video, Lowest Tax Brackets and the Worst Fiscal Balance Sheet, then you'll see that I believe tax rates are likely to be much higher in the future. Here's another opportunistic dynamic. 2022 was the third worst market year that I've seen in my entire career, and it hasn't recovered yet. So you're likely able to convert into a Roth in a down market and benefit from that accelerated growth whenever the market does finally fully recover. As an example, you might convert $100,000 into a Roth from an account that used to be worth $120,000. And someday it will be worth $120,000 again, and probably much more than that in the future. So you can convert it today and get to keep all of those future earnings tax-free. Here's a few things you need to know. You don't get the tax-free treatment on the Roth if you spend it within 5 years of converting. I recommend people keep it there for a decade. The whole advantage of the Roth is tax-free growth, so you want to give it time to grow. The conversion shows up as taxable income, so be aware of your tax bracket and other elements in your life that could change from having higher income. This could be things like taxes on Social Security, having a higher Medicare premium, or other situations where you're getting a benefit from having a lower income. Bottom line is this: the government's offer in today's low tax brackets is the best that it's been in 100 years. Their fiscal balance sheet is the worst it's been in the history of our country, meaning they'll probably have to charge much higher rates in the future. And the value of your account is probably a lot less than it's going to be a decade from now. It's simple math and capturing an opportunity. 10 or 20 years from now, you'll look like a genius. It's not cheap. The tax bill on a $100,000 conversion could be $20,000 or $30,000, depending on your tax bracket. But you can't evade taxes in a pre-tax retirement plan. Pay now or pay later. I'd rather pay now when the tax rates are really cheap and the account value is smaller. Managing your money should be a fun and liberating experience. Call us with any questions or to discuss your unique financial situation. We have lots of free resources on our website and lots of other videos to help you succeed financially.
Ta-da!